The EV revolution is accelerating. But have you ever really considered the complex journey it takes, to put one of those sleek cars on the road?
It's so much more than just the showroom, isn't it?
Exactly. It's this vast, intricate global ecosystem. It connects continents, stretches from deep underground all the way to the charging station.
A huge web.
So today on the deep dive, our mission is really to cut through some of the noise, give you a shortcut to being genuinely well informed, and maybe reveal some surprising facts.
Yeah, like how that remote mine connects to the car parked in your driveway.
Precisely. We'll unpack the entire electric vehicle supply chain, look at the hidden opportunities, the profound challenges, and we'll put two absolute titans of the EV world, Tesla and BYD, under the microscope. Understand their very different paths.
And to guide us, we're drawing on insights from sources like a step by step guide to the electric vehicle supply chain for investors and the dynamic landscape of electric vehicles. Good stuff in there.
Okay, let's unpack this then. It's easy to just see the shiny car, right? The finished product. But what's really powering this global shift?
Well, it's a phenomenon. I mean, EV sales hit 17 million in 2024. That's over 20% of all new car sales globally.
20% already. Wow.
Yeah, and the total number of EVs on the road, nearly 58 million worldwide. And China is leading with a staggering 70% market share of those EVs.
70%, that's just dominance.
It really is a massive shift. And what's truly significant here, I think, is that the journey to get an EV to you, it isn't a simple assembly line. Not at all.
Right.
It's complex, multi-stage. There are opportunities and risks at every single turn. We can kind of break it down into three main acts, if you like.
Okay.
First, the foundation, that's the raw materials. Then the midstream, where those materials get transformed into components. And finally, the final mile, getting the vehicle and its infrastructure, the chargers, to the consumer.
So it literally starts deep in the earth.
Absolutely. Every single EV journey kicks off underground with critical minerals most of us probably never even think about day to day.
Right, like lithium. That's the one everyone talks about.
Exactly. Lithium, often called white gold, it's the undisputed star, right at the heart of nearly every EV battery, but it's definitely not alone.
Okay.
You need cobalt, nickel, graphite, rare earth elements, and copper too, all absolutely critical.
Okay, so tell us about those. Lithium first. Who are the big players?
Well, for lithium, you've got huge companies like Albemarle Corporation. They produce maybe 15-20% globally, and they're a key Tesla supplier.
Ah, okay.
Geographically, Chile holds the world's largest reserves, but China's Ganfeng Lithium is also a massive vertically integrated player. That just underscores Asia's huge role right from the very start.
And cobalt. I hear that was a bit controversial.
It can be,
Yeah.
yeah. It's crucial for battery stability, energy density,
Right.
although its use is actually being reduced in some newer battery chemistries, which is interesting.
Right, trying to design it out.
Exactly. But still, almost 70% of the world's supply comes from the Democratic Republic of Congo, the DRC. Players like CMOC Group dominate there.
70% from one country. That seems risky.
It concentrates risk, absolutely. Then you've got nickel. That boosts energy density, gives you longer driving ranges. Companies like BHP supply the high purity stuff needed for batteries. Indonesia's production is booming there.
Okay, and graphite, you mentioned that too.
Huge. Graphite makes up about 95% of the anode. That's one part of the battery.
95%.
Yeah. And China processes over 70% globally. It's a critical choke point in the supply chain, no question.
Another choke point in China.
Hmm. Then you have rare earth elements, like neodymium, essential for the strong magnets you need in efficient EV motors.
Ah,
The US is actively trying to reduce reliance on China here. MP Materials is America's only rare earth mine, actually gets support from Apple and the DoD.
right, diversifying supply.
And finally, copper. Don't forget copper. EVs need about 4 times more copper than a traditional car.
4 times. Why so much?
Well, for wiring, motors, the batteries themselves, and crucially, all that charging infrastructure we need to build out, Freeport McMoran is a massive player there.
So it's not just the fancy stuff like lithium, it's basic copper too.
Absolutely. What's truly insightful here, I think, is that this isn't just about geology, it's about geopolitics.
How so?
Well, this striking concentration of extraction and the initial processing of these materials, especially in just a few key nations, it creates strategic dependencies, potential global vulnerabilities.
Like if trade disputes flare up.
Exactly. Or imagine the price of lithium quadrupling again, like it did between 2021 and 2022. That directly impacts the price you pay for any EV, or even if certain models are available. This concentration isn't just an economic fact, it's a strategic vulnerability for the entire world.
Wow. So from the deepest mines for these critical elements to the sheer volume of copper needed,
Hmm.
the foundation is clearly built on Earth's treasures. But once extracted, these raw materials don't just magically become a car part, do they?
Not quite, no.
That transformation process, the midstream you called it, sounds like another complex beast altogether. And I'm guessing China's role just gets even bigger here.
That's where it gets really interesting. Yeah, the midstream stage. This is where raw materials become usable components. And China's dominance, undeniable.
How dominant are we talking?
They process over two-thirds of the world's cobalt and lithium. And remember graphite. Over 90% of the world's graphite processing happens in China.
90%.
And when you look at the actual battery components, the anodes, the electrolytes, the battery cells themselves, China controls the vast majority of global production. We're talking nearly 96% of anodes, 82% of electrolytes, 85% of actual battery cells. It's a fundamental control point.
That level of control is just staggering. It almost makes you wonder, does this effectively give China a veto power over the global EV revolution?
It absolutely gives them significant leverage, huge leverage.
And within that landscape, who are the actual titans making the battery cells that go into all these EVs?
Well, CATL is the clear leader, contemporary Amperex technology. They've got about 38% global market share. They supply giants like Tesla, Volkswagen, BMW, pretty much everyone.
Okay, CATL. And number two.
That would be BYD. And they're interesting because they have that dual exposure, right? They make batteries and their own EVs.
Ah, right, the vertical integration.
Exactly. But what's happening now is this intense global race for battery manufacturing capacity. It's actually doubled since just 2022.
Doubled.
Yeah. Governments everywhere, the US, Europe, Asia, they're pouring money into building local cell production, trying to rebalance things, reduce that concentration risk we talked about.
Makes sense. But it's not just about batteries, right? What other components are crucial at this midstream stage?
EV motors are crucial too. Companies like Nidec from Japan, Siemens from Germany, they're major players there,
Yeah.
and semiconductors, absolutely vital. An EV needs roughly 3,000 chips.
3,000. How does that compare to a regular car?
It's about double what a modern combustion engine car needs, maybe even more depending on the features.
Wow. Who makes those?
You've got companies like Infineon, they're big in power management chips for cars, NXP Semiconductors, they do processors, and interestingly, V2X communication chips.
V2X. That's vehicles talking to other vehicles
Mhm.
and infrastructure, traffic lights, that kind of thing.
Precisely. For safety, for traffic flow.
Right.
It's all part of that vision of smart connected mobility, building out the whole ecosystem, not just the car.
So all these incredible components from minerals literally dug out of the ground to these super high-tech chips, it all leads us to what you actually see driving around every day, the finished electric vehicle.
Precisely. This is the downstream segment, the final mile, as we called it, where all those pieces come together into products and services for consumers like you.
And in terms of vehicle sales, it's been pretty dynamic lately, hasn't it? Lots of headlines about who's number one.
Very much so. BYD actually edged out Tesla in late 2024 to become the global leader in overall EV sales. Yeah, hitting about 15% market share. That was mostly driven by their huge success in China, but remember, that includes their plug-in hybrids, their PHEVs.
Ah, okay. That's an important distinction.
It is. Tesla followed closely at around 12% market share, still a giant, obviously, 100% battery electric, and massively supported by its huge supercharger network, tens of thousands of connectors worldwide.
And the traditional guys.
Oh yeah, don't count them out. Folks like Volkswagen are investing billions, literally billions, into new EV models. The race is definitely on.
Okay, so you've got one of these amazing cars. But the next big question, maybe the biggest question for many people thinking about switching,
Yes.
where do you power it up? Charging. How easy is it? How reliable is it going to be?
Exactly. And charging infrastructure is this massive new investment opportunity in itself. It's huge.
Who are the players there?
Well, you look at companies like ChargePoint Holdings. They operate over 342,000 ports, apparently controlling something like 61% of the public level 2 charging market in some regions.
Yeah.
That's the slower, more common type. EVgo is another big one. They're really focused on DC fast charging, getting you juiced up quickly on a road trip.
Right. And globally.
Globally, public charging points have basically doubled in just the last few years. We're talking millions now. But here's the kicker.
Uh-oh.
China accounts for roughly 65% of all those public chargers.
65%. So the rest of the world is playing catch-up again.
Big time. So while the number is scaling up, which is good, getting that reliable, widespread geographic coverage, That remains a key hurdle for true mass adoption, especially outside of China and maybe dense urban areas elsewhere. It's great to have millions of chargers, but if I'm driving across, say, rural America or parts of Europe, I might still be sweating about range. That imbalance is the real problem here.
Okay, so our journey has taken us deep into the Earth, across continents.
Yeah.
It's illuminated this incredibly complex tapestry of the EV supply chain. But what does this grand tour really tell us about the road ahead? What are the biggest signposts indicating opportunity, and maybe what are the warning flags?
Yeah, that's the critical question, isn't it? Because the challenges are real. That heavy geographic concentration we keep mentioning, especially China's dominance, creates definite vulnerabilities, significant geopolitical risks.
Yeah.
We've seen that commodity price volatility firsthand. Remember, lithium prices quadrupling between 2021 and 2022. That can wreak havoc on planning and costs.
Yeah.
Geopolitics, trade tensions, tariffs, localization pressures like we see with cobalt from the DRC. These are constant background noise. Things can change
Like
fast.
the economy.
Economic cycles matter, absolutely. Demand is sensitive to government incentives, interest rates making loans expensive, and just the overall vehicle prices. We saw slower growth in some months in 2025 because of those factors hitting consumers.
Hmm.
And that infrastructure lag we just talked about, charger availability, grid readiness, it's still a major hurdle in many places before everyone feels comfortable making the switch.
Okay, so those are definitely some serious challenges to navigate. But turn that coin over. Where are the next big growth engines? Where are the really massive opportunities lying in this dynamic landscape?
Oh, the opportunities are immense, absolutely. We're seeing manufacturing and, crucially, recycling getting huge investment.
Recycling, why is that so big?
Well, to reduce that supply risk we talked about, cut dependence on mining new materials, deal with battery end of life, it's becoming critical. You've got players like Redwood Materials in the US, run by a Tesla co-founder, actually, Lysical in Canada, Umicore in Europe, all racing alongside giants like CATL in China who are also big in recycling.
Interesting. What else?
Charging operators and the software behind them. Think about managing these huge networks, roaming agreements so your card works everywhere, specialized solutions for charging whole fleets of delivery vans or buses. That's a huge growth area.
Fleet electrification.
Exactly. Logistics companies, city buses, taxis, they offer predictable usage patterns, defined routes, potentially a much faster return on investment than individual consumers sometimes.
Makes sense.
And we're seeing more vertical integration. Car makers themselves investing directly upstream into raw materials, into cell production, trying to secure their own supply lines, taking control.
Like BYD, but maybe others copying that playbook.
To some extent, yeah. And policy is a massive driver everywhere. China's supportive industrial policy created their lead. Europe's strict CO2 rules are pushing adoption hard. The U.S.'s Inflation Reduction Act, with its tax credits and that focus on local sourcing, it's all shaping where these opportunities pop up, where the investment flows.
Okay. Now, when we talk EVs, inevitably two names just dominate the headlines, Tesla and BYD. But are they truly comparable? Are they really in the same league, or are we looking at two fundamentally different beasts playing different games?
That's a really sharp distinction to make because, yes, they are arguably the only two true global leaders right now in terms of volume, but their strategies and strengths are quite distinct. Very different.
Okay, break it down for us. How do they stack up?
All right, let's start with just scale and sales. Using recent 2024 data as a guide, BYD delivered around 3.8 million EVs in 2024.
3.8 million. That's huge.
It is, but it's crucial to understand that this number includes both pure battery electric vehicles, BEVs, and plug-in hybrids, PHEVs. That dual approach is key to their massive volume, especially boosting sales in China, where PHEVs are popular.
Got it. Hybrids count in their number. What about Tesla?
Tesla, meanwhile, delivered maybe 1.8 to 1.9 million vehicles in 2024, and they are exclusively 100% BEV focused, no hybrids.
Right. Apples and slightly different apples.
Exactly. So the verdict, BYD leads in total electrified units sold, especially counting those hybrids, but Tesla still leads in pure BEV sales globally and arguably has a wider, more established global footprint outside China.
And their actual business models feel almost like mirror images, don't they? Or maybe just completely different philosophies.
You're absolutely right. Completely different philosophies is a good way to put it. BYD is this manufacturing powerhouse, incredibly vertically integrated.
Out integrated.
They make their own signature blade LFP batteries that It's lithium iron phosphate. They make their own semiconductors, their own motors, most key EV components right there in-house. It's staggering.
Even sell batteries to others, right?
Yeah, they do. Their FinDreams battery division supplies Toyota for its BZ3 sedan in China, for example, and they're exploring more international partnerships. Plus, BYD is diversified into commercial EVs, buses, trucks, energy storage systems, even solar panels.
Wow. Okay, so what about Tesla's integration?
Tesla's vertical integration is much more focused on software, autopilot, FSD potential, their operating system. Their supercharger network is a huge integrated asset, and of course, their autonomous driving development.
But not so much of the physical parts.
Less so on the components historically, although they are expanding their own 4680 battery cell production, but largely they outsource battery cells from key partners.
Two of their main battery partners.
Panasonic has been a long-term partner, especially for the 2170 cells, and they're collaborating on 4680s. CATL is huge for them, particularly for the LFP prismatic cells used in standard range models made in China. And LG Energy Solutions supplies NMC cells, often for higher performance models. It's a multi-supplier strategy, which is smart for managing risk and ensuring supply.
So if BYD is the manufacturing powerhouse, what's Tesla's core advantage beyond the brand and the charging network, technology-wise?
Tesla's undeniable strength is its software. Autopilot, the potential of full self-driving that's still a big if on timing those over-the-air updates that constantly improve the car long after you've bought it. They're also pushing battery innovation with the 4680 cells, although scaling that up has proven challenging. And they're generally seen as leaders in drivetrain efficiency, getting the most miles out of each kilowatt hour.
And BYD's tech focus.
BYD's innovation, meanwhile, really centers on that Blade LFP battery. It's known for being very safe, relatively low cost compared to nickel-based chemistries. And it's been widely adopted, not just by BYD. Their focus is really on affordability, durability, making EVs accessible.
So Tesla leads on software, autonomy potential, maybe efficiency. BYD leads on proven, affordable battery tech, and manufacturing cost control.
That's a good summary. Which leads right into their brand positioning.
Yeah, how do people see them?
Tesla is the aspirational premium tech brand. People talk about it being the Apple of cars. It has strong global recognition, a lifestyle image.
Right.
BYD is positioned more as the practical, affordable, high-volume leader. They have models like the Seagull, which sells for the equivalent of around 10,000 US dollars in China. They have huge domestic loyalty, and they're working hard now to build that brand internationally.
Are very different markets they're targeting, fundamentally.
Very different. Financially, just briefly, Tesla historically had industry-leading profit margins, though those aggressive price cuts in 2024-25 definitely compressed them quite a bit. They likely still maintain stronger profitability per car than BYD.
But BYD makes up for it with volume.
Exactly. BYD relies on sheer scale and that tight vertical cost control. The gap in overall profitability might be narrowing, though. It's something investors watch very closely.
Okay, so despite being these clear global leaders, number one and number two, both Tesla and BYD stocks have, well, let's be honest, taken a pretty significant beating recently. What is going on there? Why are investors suddenly cooling off?
Yeah, that's a really important question for anyone watching this space, whether you're invested or just curious. The sell-off isn't just about one company messing up. It reflects some pretty strong industry-wide headwinds mixed with some company-specific issues.
Okay, what are the industry headwinds affecting everyone?
On the industry front, first off, we've definitely seen an EV demand slowdown. Now, sales are still rising, let's be clear, but not at that breakneck hypergrowth pace we saw from maybe 2020 to 2023.
Why the slowdown?
Several reasons. Tapering subsidies, especially in places like China and parts of Europe. Uneven adoption rates, the US is still lagging Europe and China. Higher interest rates globally make car loans pricier for everyone. And there are still lingering consumer concerns about affordability and charging convenience.
And the price wars.
Oh, yeah, the infamous price wars. Both BYD and Tesla aggressively slashed prices, particularly in China, to gain or maintain market share. That definitely boosted unit sales numbers, which looked good on the surface.
But killed margins.
Exactly. It sharply reduced profit margins. And investors started thinking, hang on, maybe EVs aren't this perpetual high-margin tech product we thought they were. Maybe this is just turning into a really competitive traditional auto industry business, which, of course, tends to command much lower valuations in the stock market.
Right, less like Apple, more like Ford or GM.
In terms of margins and competitive intensity, potentially, yes. And you just layer on top of that broader macro headwinds. Higher interest rates globally, fears about a global recession, and weaker consumer sentiment, particularly in China, which is such a huge market, it all adds pressure.
So those are pressures hitting the whole sector. But what about issues specific to Tesla that might have spooked investors particularly?
For Tesla specifically, a few things stand out. That margin compression was a big one for them. Seeing their auto gross margins fall from that historical 25–30% range, which was unheard of in the auto industry, down into the low teens in 2024–25.
Yeah.
That really changed the narrative.
Yeah, it's a big drop.
Huge. Their model lineup is also seen by some critics as getting a bit long in the tooth, maybe overly reliant on the Model 3 and Model Y. The Cybertruck is pretty niche, exciting, but niche, and there's still no sign of that promised next generation, truly mass market, more affordable model yet.
The $25,000 Tesla people talk about.
Exactly. Plus, the timelines for full self-driving, FSD, keep slipping. A lot of Tesla's sky-high valuation was built on the promise of FSD solving autonomy and unlocking robo-taxi fleets. Delays dampen that crucial tech premium narrative. So all of that has contributed to a kind of valuation reset, with Tesla being re-rated by many investors closer to a traditional, albeit premium, car maker multiple rather than a pure tech multiple.
Okay. And BYD, what unique challenges are they facing that might be weighing on their stock? They seem to be hitting volume targets mostly.
BYD has its own set of challenges, definitely. A big one is that heavy China overexposure we mentioned. With over 80% of their sales still domestic, they're highly vulnerable if China's economy stays weak or if competition there gets even more brutal.
And the competition is brutal there, right?
Insane. There are persistent fears about overcapacity in the Chinese EV market, leading to those never-ending price wars. Everyone's fighting for share. And while exporting is great for diversification, and they are pushing hard into Europe, Southeast Asia, Latin America, it's not always super profitable initially. You've got shipping costs, import duties, setting up service networks, potential tariffs.
Right. It costs money to expand globally.
It does. Plus, there's the investor perception factor again. Despite their battery tech and integration, they're often valued more like a traditional, albeit very successful, manufacturer rather than a disruptive tech company like Tesla has been historically perceived.
And BYD has been particularly prominent in the financial news just recently, facing some specific headwinds, haven't they?
Yes, these recent developments really underscore the intense pressures even the biggest players are facing. BYD's latest earnings report, showing its first quarterly profit drop in over 3 years, certainly caught attention as a significant 30% decline.
30% drop. Wow. What caused that?
It was largely put down to that fierce price competition in China, plus a 1 billion yuan incentive they gave to dealers that reportedly didn't boost sales as much as they'd hoped. This led to a substantial loss in their market value. Stock dropped over 30%, and they had to revise their annual delivery target downwards, from 5.5 million vehicles to 4.6 million.
That's a big revision.
It is. And adding another layer, BYD also announced a technical change recently. They're reducing their H-share board lot size on the Hong Kong exchange.
What does that mean, board lot size?
It's essentially the minimum block of shares you have to buy or sell. They're cutting it from 500 shares down to 100, effective September 19th, 2025. The stated reason is to enhance liquidity, make the stock flow better, and broaden the shareholder base by making it easier for smaller retail investors to buy in.
Okay. Sounds positive.
On the surface, yes. However, announcing this right when earnings are declining, well, it could be perceived by some skeptical market watchers as perhaps a response to liquidity concerns, or maybe an attempt to support the stock price by attracting more buyers. The timing adds a layer of complexity to interpreting that move.
I see. So the big picture shift in investor sentiment across the board, it sounds like it's really been from maybe hype and hope to a dose of reality.
That's a very good way to put it. The initial euphoria saw valuations soar based on future potential, but the last couple of years brought a bit of a deflation, maybe, as the reality sunk in that this is fundamentally a capital-intensive, highly competitive global auto industry. It's not easy money.
Right.
So now investors are looking less at just how many cars were sold last quarter and more critically at things like profit margins, free cash flow generation, and what really gives a company a sustainable competitive advantage in this tough market. The focus has sharpened.
That makes sense. So if we think about these two giants, Tesla and BYD, through the lens of economic cycles, how might they perform differently when times are good versus when things get tough? Is one inherently more resilient, do you think?
That's a great way to frame it. It highlights their different strengths. During an expansion cycle, when the economy is generally doing well, disposable incomes are up, Tesla often benefits significantly.
Why Tesla?
Its premium positioning resonates more. Consumers are more willing to pay up for that aspirational brand, the latest tech. Its valuation tends to expand as investors get optimistic about growth. You could almost say Tesla acts like a high beta EV stock, meaning its share price tends to swing more dramatically, both up and down, than the broader market.
Okay. And BYD in good times.
BYD, during good times, benefits hugely from its scale and that focus on affordability. They can capture massive volume, especially in China, where they are so dominant in the mainstream market.
But what about when things tighten up? A contraction cycle.
Now that's where BYD appears structurally better positioned, arguably,
Why is that?
because of that affordability focus. And importantly, because of their significant plug-in hybrid PHEV lineup. In tougher times, consumers might trade down from premium brands or delay buying a pure EV due to range anxiety or cost. BYD's more affordable EVs and their PHEVs offer a bridge, making their offerings potentially more appealing. They're arguably more resilient to demand shocks.
While Tesla being more premium.
Exactly. Tesla, being more skewed towards the luxury premium end of the market, is naturally more exposed when consumers pull back on big-ticket discretionary spending. So maybe BYD could be seen as a lower beta EV stock, perhaps a bit steadier, more closely tied to the underlying long-term trend of mass EV adoption, even if the pace fluctuates month to month.
Interesting comparison. Now, one last thing on their dynamic. Does Tesla paving the way, being the trailblazer that made EVs cool, does that ultimately help BYD? Or are they just constantly locked in direct zero-sum competition where one's gain is the other's loss?
It's probably a bit of both, really. It's not purely zero-sum.
How does Tesla help them?
Indirectly, absolutely. Tesla helps BYD and the whole industry. Tesla is the ultimate validator of EVs. They made electric cool, desirable. They forced the entire legacy auto industry kicking and screaming to take EVs seriously. They pushed charging infrastructure forward globally. All that boosts overall EV sentiment, creates the market, which benefits everyone, including BYD, who can then come in and scale up.
But they definitely compete hard.
Oh, absolutely. They're fierce competitors, no doubt about it. Tesla's price cuts, especially in China, directly impact BYD's pricing power and margins. They are fighting for the same pool of customers in many segments.
So how do you reconcile that? Helper and competitor.
Maybe think of it like this. Tesla was the trailblazer, the one hacking the path through the jungle with a machete, showing it could be done. BYD is now the scaler, the one coming in behind with the bulldozers, building the superhighway to bring mass adoption to everyone. Both are crucial for the journey, but they definitely compete for space on the road they're building.
That's a great analogy. Okay, we've talked a lot about performance, competition, challenges, but when it comes down to investing, valuation is absolutely key. Why on earth is there such a massive difference in how the market values Tesla versus BYD? As of mid-September 2025, roughly, Tesla trades with a market cap around $1.3 trillion. Its forward price-to-earnings ratio, the PE, is maybe 180 times earnings.
Astronomical numbers.
Right. BYD, in contrast, the global leader by volume, if you count hybrids, has a market cap of around $130 billion, a tenth of Tesla's. And its forward PE is perhaps in the 20-25x range. That is a huge, huge divergence for the number one and number two global EV players. What explains that gap?
This really raises a truly important question for you, the listener, especially if you're an investor trying to understand this space. Why does Tesla consistently command that massive premium? There are several key reasons, usually cited by analysts and bulls.
As they'll leave out.
First, that unparalleled global brand power. The Apple of EVs narrative is sticky, representing tech, lifestyle, aspiration. It's a powerful brand. Second, investors heavily price in the optionality of its software and autonomy bets. There's a strong belief, or hope, in future high-margin revenue streams from full self-driving software subscriptions, robo-taxis, maybe even licensing their AI work. That future potential gets baked into the price today.
The jam tomorrow argument.
To some extent, yes. Third is the ecosystem integration. The cars, plus the supercharger network, plus their solar products, plus battery storage, Powerwall Megapack. It's seen as a cohesive energy and transport ecosystem. Add to that its history of delivering, until recently, very high margins compared to other automakers, and a very passionate, loyal retail investor following that often looks past near-term challenges. All that helps support the premium valuation.
Okay, that makes sense for Tesla's high valuation.
Right.
But flip it around. Why does BYD, despite its incredible scale, its vertical integration, its clear battery leadership, why does it trade so much cheaper? And 2025 XPE is respectable for a manufacturer, but tiny compared to Tesla.
BYD tends to trade at that discount for a confluence of reasons, too. A big one is simply the perception as primarily a Chinese automaker operating in that incredibly cutthroat domestic market.
A China risk premium.
Exactly. Investors often apply what analysts call a China risk premium. They factor in risks related to potential macro slowdowns in China, unpredictable regulatory shifts, and ongoing geopolitical or trade tensions. That weighs on the valuation.
Okay, what else?
Then there are the fundamentals we discussed. BYD generally has lower per car profit margins than Tesla, even if their total volume is higher. And outside of China, their global brand recognition, while growing fast, still isn't anywhere near Tesla's level yet.
So it's valued differently.
Fundamentally, yes.
Hmm.
BYD is largely valued by the market like a capital-intensive manufacturer, a very successful one, but a manufacturer nonetheless, not primarily as a high-growth tech disruptor in the way Tesla often is.
So it really comes down to how you view them.
Precisely. The ultimate insight here, perhaps, is that when you look at Tesla versus BYD, you're not just comparing car companies selling similar products, you're comparing two fundamentally different visions of the future and two different investment theses.
How so?
Tesla is largely priced as a tech disruptor, a bet on software, AI, and that future optionality really paying off. BYD is priced more as a manufacturing leader, a bet on industrial prowess, volume, cost control, and dominating mass market adoption, particularly with affordable models. Your investment choice isn't just about today's sales figures, it's really about which future narrative you believe in more strongly. Two different bets, really.
What a journey. We've truly traveled through the entire EV supply chain today, haven't we?
We really have. From deep underground.
Exactly. From those critical raw materials buried deep in the earth, through complex manufacturing processes dominated by certain players, right to the final vehicle rolling onto the road and the charging network that powers it all.
Covered a lot of ground.
And we've taken that deep dive into the distinct strategies, the strengths, the challenges facing those two EV giants, Tesla and BYD.
Yeah.
Hopefully, we've shed some light on why their valuations tell such remarkably different stories right now.
Yeah, hopefully for you, listening in, whether you're an investor trying to make sense of the market swings, just a curious consumer wondering about the car you drive or maybe the one you're thinking of buying, or perhaps someone prepping for a crucial meeting on this topic, we hope grasping this complex ecosystem helps you understand the profound opportunities out there, but also the very real risks that are reshaping the future of transportation and honestly, way beyond just transportation. It touches energy, geopolitics, everything.
Absolutely. So here's a final thought to leave you with something to ponder on your own. As governments around the world keep pushing for localization of these supply chains, trying to shift away from that heavy concentration we saw, especially in processing, and as new battery chemistries continue to emerge, perhaps using less cobalt, maybe different materials altogether like sodium ion, what critical raw material or perhaps what innovative new technology do you think might be the next white gold? What's the next potential bottleneck or the next breakthrough that could truly redefine the EV landscape in the coming decade?